Hi, I'm Malik King, a macro and technicals desk analyst at Barclays Capital. Today we're going to be talking about technical tools, three basic topics here. What are support and resistance, polarization reversals on a breakout and why that happens, and then different types of support and resistance and what we should look for. So what are support and resistance? They're basically pockets of supply or demand. These are investors who want to buy or sell at a particular price. So support is basically that pocket of demand which supports stock prices or security prices within a downtrend, something that's falling, it gives it support. And resistance is a pocket of supply that resists the up move as a security or stocker, such as in an up move. They often tend to coincide with major fundamental levels or prices from fundamental news or events as well. So here's one quick example looking at Priceline and looking at the news-driven component of that support and resistance sometimes. Priceline's seen several high-volume gaps upward from strong positive earnings reports. These gaps have had the tendency to serve as support in the ensuing weeks or months. So here we're going back and looking from November 2009. You had a big gap higher. It took quite some time before it actually ever came back and retested. It wasn't until more than 6 months later. But once you did get back into that area, you saw that area serve as support in May, June, and July again of 2010. You had a smaller gap higher again on earnings in February of 2010. And you gapped higher, came back down. Once you got back down to that area, again served as support. Right? Why that investors who liked it but didn't get a chance to get in when it gapped higher, once it got back down to that area, those same investors wanted to buy it again. All right, so here we see another example in late 2010 into early 2011. Big gap higher on, again, earnings here in November, and that same price point serving as support each time it got hit going forward. Polarization tends to reverse on a breakout, whether it's break higher or break lower. So broken resistance becomes support and vice versa. This is basically for a couple of reasons. It's due to replacement of demand or supply. So in the case of a resistance being broken, you're replacing supply with demand, and we'll get into that in a second. And then also due to trader psychology, which we'll look at as well. So here's one quick example. How resistance becomes support, right? Let's say we've got a stock that's been trading between $20 and $30. So let's say initially you have 200 people who want to sell this stock at $30. So you get up to $30. 50 of those investors sell it. There's 150 sellers left at that point, right? But by the time 50 sell, the stock is heading down again. You ran out of buyers, and that 150 didn't get a chance to sell at 30. You come back up. There's still 150 investors who wanted to sell. So 50 more of them are able to sell before the stock, starts heading back down. You've now got 100 left who want to sell the stock. It comes back up. You had 150 sell, 50 remain. Comes back down. You come back up one more time. Your last 50 sellers sell out at $30. Right, so you had 200 sellers who wanted to get rid of the stock at $30. None of them are left, right? You actually have replacement, right? So owners who were sellers at 30 have now been replaced with owners of the stock or investors who wanted to buy at 30, right? So 50 people bought here, 50 more bought here, 50 more bought here, 50 more bought here, right? So all of that supply of those who wanted to sell the stock at 30 are gone and have been replaced with that the same number of investors who wanted to buy at that price. So in general, you've got what would be considered stronger holders now at that price. Additionally, psychology creates two new sources of demand. Right? One, you've got missed opportunity buyers, and that's those who said, oh, I wanted to buy it at 30, but I didn't get a chance. And we just took a look at one of those situations on that prior gap in Priceline. And so when the stock comes back down to 30, those missed opportunity buyers are saying, hey, I really want to buy it here, right? So that becomes an additional source of demand. Additionally, you've got people who were, say, shorting every time it hit 30, short again. And so those who shorted at 30 on this last piece right before it broke out are now down on their positions. So if the stock comes back and they get an opportunity to get out at even, investors or traders have a tendency to do that. Yeah, and so that's one further source of demand, is those shorts trying to get out as well. So different types of support and resistance. We see former price levels or range tend to be support or resistance. That includes gaps like we looked at before. Trend lines as well, and moving averages. So there's a few more that we'll go into in a minute also. So support and resistance, prior reversals or trend lines. Here, looking at multi-year chart of Home Depot, that $31 to $32 area tended to be support for quite a number of years. So we saw here in 2003 a number of times that once you got down to 31, 32, it held. You saw it get close but not quite there in 2006, and then again in late 2007 before breaking. And here that same polarization reversal, once it broke, that same level served as resistance here, and again in 2008. We also saw a prior reversal at 44 back in 2004, served as resistance again. Yeah, and then trend lines as well, support, 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 and then up here once it's been broken, that retest is serving as resistance. So we can also take a look at moving averages. Just looking at the S&P going back over the last year for shorter term stuff, or many years for longer term stuff, the 20 and 50-day moving averages has often served as support and resistance, and as a sign of the direction of the trend. The 20-day for the short-term trend, the 50-day for an intermediate-term trend. So up here we see these green circles as let's say the 20-day is serving as support here, right? The market trends higher, comes back down, finally breaks the 20-day, and then breaks the 50-day. Once the index rebounds to retest them, both of those are now serving as resistance. 50-day is resistance, 20-day is resistance, and then you see them reverse, and both headed higher again, a couple of support points. So we've seen that occur a number of times. Longer term or bigger picture, you see the 80-week moving average had also been a key area of support and an indicator of the longer-term trend, as we've seen several support points on the way up, resistance on the way down, support on the way up, and so forth. So different types of support and resistance. We also want to take a look at Fibonacci retracements, of which the 38%, 50%, and 62% retracement are the most common. We kind of look at it as the either 1/3 or 3/8 to 5/8 or 2/3. In terms of the major areas that tend to serve as support and resistance, and then also psychological price points as well. And that's round numbers like $10, $20, $50, $100, $1,000. So looking at these Fibonacci retracements. Both of these slides are of the S&P 500, one big picture, one somewhat smaller picture. Looking at the run-up from 1982 up through around where we are today, if we looked at the bear market in 1987, this was a 50% retracement. That's in terms of points. So it's half the points of the entire bull market move from 1982 up through 87. So that 5-year move, we start a bear market, stops just at the 50% retracement, right? So it ends up being major relative support. Looking even bigger, going back over the last 25 years, the bear market from 2007 high down to the 2009 low was right at almost a perfect 62% retracement of the entire 25-year rise, right? And so we're seeing these Fibonacci retracements, especially the 50%, the 60%, the 38%, serve as major support and resistance for significant moves. Taking it down to a slightly shorter term picture, the April of 2010 high, which started a 17% decline over what was effectively just 2 months, or just a little over 2 months. So pretty significant high here. This came right at a 62% retracement of the entire 07 to 09 bear market. So again, significant point right at that 62%. Looking even shorter term, it's a little tough to see, but where did this retracement end? Well, that April 2010 to July 2010 sell-off, that said was 16 or 17%. That was a 38% retracement of the entire run-up from the 2009 low. Right, so you had March 2009 all the way up to April 2010, and we finally get this larger sell-off. Where does it stop? 38% retracement of the move. And then taking it down even smaller scale, and this is really tough to see, but this 16-17% decline, when you finally came up from this July low into August, and then rolled over and had a quick, what was about a 3-week sell-off before kick-starting a larger move higher, where did it stop? This run-up from July into August stopped just between the 50 and 62% retracement of that April to July sell-off. So not easy to see on this chart because we're trying to look at a lot of different time frames at once. But at the end of the day, those Fibonacci retracements tend to very, very often serve as support and resistance around these critical turns. So the last area of support and resistance, major round numbers. And again, this can be $10, $20, $50, but especially when we get to these major $100, $1,000 price points, you often see these things holding for months or even years. If we look at Amazon here on the left, when it first hit $100, it serves as resistance, held again, had a major bear market, came all the way back up, and we still saw it hold again a number of times. This actually, basically that 100 mark held for a full decade before it turned from resistance into support. The Dow Industrials stuck basically at 1,000 for nearly 2 decades, from back here in the mid-60s all the way up to the early 80s when he finally broke out for the last time. And that's 1, 2, 3, 4, basically 5 major times that you kick-started significant declines from that level. Gold at $1,000, you saw the same thing. It was stuck for nearly 2 years. 1,000 coming back down to 700, up again, down again, up again, down again, and then finally breaking through in what I think was late 09. So that $1,000 mark, and we've seen it on quite a number of other indices as well, serving as pretty significant level in terms of round number resistance or support. So that about covers it. This concludes the segment on support and resistance. For the Market Technicians Association, I'm Malik King, Macro and Technicals Desk Analyst at Barclays Capital. Thank you for joining us today.